Imagine it's the first day of every month. Without lifting a finger, $1,000 quietly moves into your investment account. Not just once, but every month, automatically, year after year. You're not day trading, you're not chasing crypto hype. You're just quietly investing $1,000 per month. Now fast forward 30 years. What does that decision actually become? Most people hear $1,000 a month and think one of two things. Some think, that's massive, that will make me rich. Others think, that's nowhere near enough to matter. Both reactions miss something important. Because where you actually end up doesn't depend on the $1,000 alone. It depends on three forces most people underestimate: time, rate of return, behavioral consistency. Let's start with something simple. If you invest $1,000 per month for 30 years without any growth at all, you would contribute. $1,000 into 12 months into 30 years is equal to $360,000. That's your money, your effort, your deposits. Now here's where reality shifts. Money invested in diversified stock markets historically returns around 7 to 10% annually over long periods. Not every year, but over decades. For reference, the broad U.S. market, represented by the S&P 500, has historically averaged roughly 10% annual returns before inflation over long time frames. That number is not a guarantee. It's not smooth, but it's a useful baseline for long-term modeling. Now, here's what most people don't intuitively grasp. The majority of your ending balance won't come from your contributions. It will come from growth. And growth compounds, which means returns generate returns, which then generate more returns. The effect is slow at first, then quiet, then invisible, and then suddenly overwhelming. But before we jump to projections, we need to address something uncomfortable. Consistency is rare. Plenty of people can invest $1,000 once. Far fewer can do it for 360 consecutive months. Because $1,000 a month is not just a financial decision. It's a lifestyle decision. It's saying no to a slightly nicer car, a larger apartment, frequent upgrades, daily convenience spending. Not dramatically, just repeatedly. And here's the truth most financial influencers skip. If you invest $1,000 per month for 30 years at 8% annual returns, you do not become a billionaire. You don't even become ultra wealthy. But you do cross into something far more powerful: financial independence territory. That's the part we're going to calculate precisely. Because once you see the real numbers, not hype, not fantasy, you'll understand something important. The outcome isn't magical, it's mechanical. And mechanical systems reward consistency. In the next section, we're going to walk through exactly where $1,000 per month leads at: 5% returns, 7% returns, 8% returns, 10% returns. And then we'll compare what actually happens when inflation is factored in. Some of those numbers will surprise you, not because they're extreme, but because they're achievable. And achievable outcomes are far more dangerous and powerful than unrealistic dreams. Now let's turn that into real numbers. To understand where $1,000 per month actually ends up after 30 years, we use something called future value, which simply means how much your money can grow to over time with compound interest. The idea is simple. Every dollar you invest earns a return, and then that return also starts earning more returns. That's how money grows. Compound interest doesn't grow in a straight line. It grows slowly at first, and then faster and faster as the years pass. This happens because you're earning returns on top of previous returns, especially when you keep investing consistently every month. When you invest regularly, your rate of return makes a huge difference. It's not just about how much you put in, it's about how much that money grows. If you invest $1,000 per month for 30 years with no return at all, you would contribute $360,000 in total. But once you add growth, the final amount can be much higher. Let's look at a few simple examples. If you earn around 5% per year, which is considered a conservative return, your total will grow well beyond the $360,000 you contributed. Over 30 years, even a modest return like 5% can more than double what you put in because of compounding. If you earn around 7 to 8% per year, which many investors consider a reasonable long-term average for a stock-heavy portfolio, the growth becomes much stronger. Historically, broad market indexes like the S&P 500 have averaged returns in the high single digits over long periods, including dividends being reinvested. At this level, your investment could grow to well over $1 million after 30 years. If your return is closer to 9 to 10% per year, which reflects long-term historical averages of the S&P 500 in certain periods, the final number becomes dramatically larger. At about 9.5% annual growth, investing $1,000 per month for 30 years could grow to around $1.70 to $1.8 million. That number is not random. It comes directly from compound interest calculations based on long-term market history. It's also important to understand that these percentages are not guaranteed every single year. Markets don't give you the same return annually. Some years will be negative. Some years will be very strong. These numbers are long-term averages. The key is staying invested through both the ups and downs, because pulling your money out during a downturn can interrupt the long-term growth process. At first, $1,000 per month may not seem life-changing. It can feel like just another expense or savings habit. But over decades, most of your final wealth doesn't come from the money you deposit. It comes from the returns those deposits generate, and the returns on those returns. If you stay invested for 30 years and earn somewhere in the 7 to 9% historical range, you're not just saving money. You're building something that grows quietly in the background, year after year. And these numbers aren't unrealistic. They're based on how markets have actually performed over long periods of time. Most people never reach the big projected numbers from investing because of small choices and habits that quietly work against them. One of the main reasons is not having a clear plan. Many people save when they feel like it and spend when something feels urgent or exciting. It's like starting a long journey without a map. You might move, but you won't reach the destination you want. Someone might say, "I'll invest someday," without deciding how much to invest, where to put it, when to start, or how long to stay invested. Without these details, it's easy to delay or give up during tough times. A written plan changes that, turning vague hope into real action. Another common trap is spending more as income rises, which is called lifestyle inflation. When people get a raise or higher salary, they often spend it on nicer things instead of investing more. Every extra dollar that goes into bigger rent, fancier cars, or expensive gadgets is a dollar that isn't compounding for the future. Over decades, this can keep someone's wealth stagnant even as their earnings grow. Emotions also play a big role in why many people fail. Fear and greed distort logic. When the market drops, people panic and sell. When prices rise quickly, they buy in fear of missing out. Selling low and buying high is the opposite of what investing requires. For example, seeing a stock drop 15% may feel like a disaster, but historically, markets recover and continue growing. Emotional decisions like this interrupt the compound interest cycle. A lack of financial knowledge is another reason. Many people avoid investing simply because they don't understand stocks, bonds, mutual funds, or risk. They may stick all their money in a savings account or avoid the market entirely. Even learning basic concepts like diversification, dividends, and risk management can make a huge difference. People with financial literacy tend to invest more consistently and make better long-term decisions. Short-term thinking also prevents success. Many investors say they are long-term but act otherwise. Market news, hot stock tips, or sudden price swings lead to panic or impulsive actions. Long-term investing means ignoring daily price movements and focusing on decades. Markets fluctuate constantly, but the overall trend over 30 years matters far more than day-to-day changes. Fear of loss is another psychological hurdle. People feel losing money more strongly than gaining it, which can make them sell too early or avoid investing at all. Losses are part of investing, and the key is staying consistent and not abandoning the plan during tough patches. While most people falter, some investors do reach their big long-term numbers. The difference isn't intelligence, but habits, mindset, and consistency. Successful investors think in long-term timeframes, focusing on years and decades instead of daily fluctuations. They ask themselves, will this strategy still make sense in 10 years? Instead of reacting to short-term fear, they also automate their savings. Automatic transfers to investment accounts remove emotion from the process. For example, if $1,000 moves automatically each month before they see it in their bank account, it avoids temptation to spend it. A written plan is another habit that separates successful investors. They define why they are investing, their risk tolerance, what to do during downturns, when to rebalance, and their long-term goals. This plan becomes a guide when markets get noisy and prevents panic-driven decisions. Successful investors diversify and manage risk by spreading money across stocks, bonds, or index funds. If one investment falls, others balance the loss. They continue learning about markets, companies, and investment strategies, which improves their decisions and helps avoid outdated advice. They keep emotions under control, staying calm during drops and avoiding hype-driven purchases. They understand their limits and invest in what they know or have studied, avoiding risky speculation. They balance risk and reward intentionally, rather than chasing the highest possible return. Lifestyle inflation is avoided. Extra income is invested rather than spent, which dramatically multiplies compound growth over decades. Finally, they learn from mistakes instead of quitting. Every wrong decision is reviewed and adjusted, which makes them stronger and more consistent over time. These habits, discipline, and long-term mindset are what allow some investors to turn modest monthly contributions into substantial wealth over decades. While most people stop short along the way, those who stay consistent, patient, and educated let compound interest work quietly but powerfully for them. Many people wonder, is it too late for me to start investing? The answer depends on when you begin, but the truth is, starting at any age is better than not starting at all. Time is a powerful ally in investing, and compound interest works differently depending on how early or late you start. Let's imagine 3 people, Emily, James, and Michael. Emily starts investing $1,000 per month at age 25, James starts at 35, and Michael starts at 45. All 3 aim for the same 30-year time horizon for simplicity, though realistically, their investment horizons differ. Emily, starting at 25, benefits from the magic of time. Even a modest annual return of 7% allows her money to grow significantly because each year's earnings have more years to compound. By age 55, her $1,000 monthly contributions can grow to over $1.2 million. The key isn't that she invested more per month, but that her contributions had 30 years to grow exponentially. James, who starts at 35, has 10 fewer years than Emily. To reach a similar number by retirement, he would need to either contribute more each month or take on higher investment risk to chase larger returns. Starting later doesn't mean failure, but it does mean the compounding advantage is smaller. At the same 7% return, his monthly $1,000 investment over 20 years might grow to around $500,000 to $600,000, a good sum, but far less than Emily's. Michael, beginning at 45, has an even shorter time horizon. He faces the psychological challenge of feeling behind, but he can still make a meaningful impact by increasing his contributions and staying disciplined. If he invests $1,500 to $2,000 per month for 15 to 20 years at a reasonable return, he can still build a nest egg of several $100,000. The principle is the same: consistent investment and patience. Even starting late, he benefits from the power of compounding, just at a smaller scale. These scenarios highlight why early investing is often emphasized, but they also show that investing at any age has value. What matters most is starting now and sticking with it. Delaying only reduces your advantage over time. Every year you wait is a year lost in the exponential growth process. Beyond age and contributions, psychological framing plays a massive role in successful investing. One effective approach is to treat your monthly investment as a non-negotiable expense, much like rent or groceries. By framing it as essential, you avoid the temptation to skip months or spend impulsively. Automating investments reinforces this principle. When money moves automatically to your account, you don't even have to think about it. Your future self is already being taken care of. Another psychological tactic is visualizing long-term results. Instead of focusing on daily market swings, imagine your money 10, 20, or 30 years from now. Small, consistent actions compound into big results. Seeing a chart of growth over decades, even if it fluctuates along the way, helps maintain perspective. Many successful investors emphasize this kind of visualization because it builds patience and reduces emotional reactions. It's also important to reframe setbacks. Market downturns, missed months, or small mistakes are inevitable. Instead of panicking, see them as part of the journey. Historically, markets recover over time. Those who stay invested, even during challenging years, benefit from the rebound. The key isn't perfection, it's consistency and the willingness to learn from mistakes. Practical strategies based on age and psychology can make investing easier. For young investors like Emily, the focus is on maximizing the advantage of time. Even small monthly contributions grow significantly over decades. Diversification and steady contributions matter more than chasing hot stocks or short-term gains. She can take moderate risks because time allows her to recover from market dips. For mid-age investors like James, the strategy shifts slightly. He might need to increase contributions or choose investments with slightly higher expected returns. He should still avoid panic selling and stick to a plan. By breaking the journey into smaller milestones, such as 5-year review points, he can stay motivated and track progress without feeling overwhelmed. For late starters like Michael, the psychological challenge is often the strongest. He might feel he's behind and that achieving financial freedom is impossible. But the reality is that any consistent investment, especially when paired with disciplined saving, still makes a difference. Late starters benefit from focusing on controllable factors, monthly contributions, choosing diversified assets, and avoiding emotional decisions. Even if he cannot reach $1 million balance, he can still secure a comfortable financial cushion. Another useful psychological approach is habit stacking. Pair investing with something you already do regularly. For example, whenever you get paid, have a small portion automatically invested before you pay bills or spend on discretionary items. Making it automatic removes the mental friction of decision-making and ensures consistency. Over decades, these habits can create massive long-term results. Finally, framing investing as a long-term game rather than a short-term gamble is critical. Most people fail because they treat investing like betting. They react to news, rumors, and temporary losses. Successful investors focus on decades, not days. They know that patience, consistency, and disciplined contributions yield compounding benefits far beyond what most people realize. The overarching lesson is clear. No matter your age, starting to invest now and maintaining consistent contributions allows you to harness the power of compounding. Time magnifies results for younger investors, but even late starters can see meaningful growth if they remain disciplined. Psychological tools like automating contributions, visualizing long-term growth, and reframing setbacks make the process easier and reduce emotional errors. By combining age-appropriate strategies with sound psychological framing, anyone can create a powerful financial engine. The numbers may vary. Younger investors will see higher totals due to more compounding time. But the principle is the same. Small, regular, disciplined contributions grow quietly over time, eventually turning modest monthly savings into a substantial long-term wealth foundation. Starting today, no matter your age, is better than waiting. The future value of your consistent actions, even if it feels small now, is much larger than it appears in the moment. Compound interest, combined with time, discipline, and a clear mental framework, allows ordinary investors to achieve extraordinary results.